I'm Daniel Rondberg, and I'm extremely excited and honored to be hosting John Reed today. He is my go-to in terms of premium finance. He's the expert and somebody who is very reputable and trustworthy in our industry. And I'm grateful that he's carved out a little bit of time to talk with me. John, thanks so much for being here, man.
Oh, happy to be here, Daniel. Thanks for making time this morning. This is a nice way to start the day.
It's incredible. And selfishly for me, I want to bring this content to people, but I'm here to learn because I share with you my story of being an agent for the last 10 years, not having very much experience with premium finance at all, but something that I feel is extremely valuable for the right person. And so I wanted to talk about just a few ways we could outline kind of the basics of premium finance, what it is, who it's here to serve, where you're looking to help people. But first, how did you get started in premium finance?
Great question. I was a career agent with Northwestern Mutual back in the day. It's how I got into the industry. And I had an advisor I met when we started working in the non-qualified deferred comp space. We started working with much higher level income earners, very wealthy business owners. And I was introduced to kind of the guy who created this concept, who kind of mass marketed premium financing out in Southern California. And he became a mentor of mine. And I'm an engineer by background, so I don't believe anything. Like anything that's marketing hype, I don't want to believe it. I want to dig into it.
Yeah.
And I spent probably 3 months with him just digging into how does premium financing work? What are the mechanics? What are the risks? What are the upside? How does this work for comprehensive planning? And once it all fell into place, I go, this is the most brilliant thing I've ever seen. I've never seen something that's so efficient for big wealth transfers as this concept. And I asked him, I said, I want to work with you. I mentioned to you once before, I always ask, who do I have to bring to the table to bring you to the table?
Yeah.
I asked him, I said, I want to work with you. Who do I need to bring? And he kind of outlined who the ideal client was, and then ultimately just brought me in-house. And so I've been doing premium financing exclusively since 2015. So we're going on 7.5 years now, and I've worked with a couple hundred clients, implemented a couple hundred deals. So I'm sure I've talked to probably 1,000 advisors or clients in the past 7 years, but worked on a couple hundred deals, probably put in force $1.5 billion of face value.
Whoa.
Got to work on a lot of transactions, but that's how I got started into it.
That's incredible. You're definitely the authority. And I should mention too that John is such a wealth of knowledge, and I love talking to him so much. We were supposed to start this interview a while ago, but we just got talking because he's got so many valuable things that I love in personal philosophies, and you just have so much integrity. That's what I really have a lot of respect for you, because you're doing it the right way. I mean, $1.5 billion of face the right way is hard to do, and you're doing an incredible job. So I think that's amazing. What is premium finance?
So premium financing is as simple as it's really the combination of two things. I'm very mathematical, so everything's kind of an equation. It's a life insurance policy, which is typically a retail insurance contract, meaning it's a whole life, an IUL or a UL contract, a permanent insurance policy, and a loan, which is funding it. And when you put the two together, that's what creates premium financing. It's as simple as that. It's what it does and how it works and who uses it. That's where you get into the nuances. But the simplistic answer is it's financing life insurance.
And why do people do that?
So I look at it as I have like a three-step qualification I use, which is people use premium financing for they use it because they need life insurance for their planning efforts. They've already sat down with an advisor. They've realized that there is a need for life insurance to support their estate tax planning, their liquidity planning, their retirement income, their income replacement, their buy-sell agreement, their key person, their business succession. There's a planning driven need that's identified life insurance as a efficient tool to fund it. That's number one, need for life insurance. Number two is that they have the capability of funding the policy. The contracts we're talking about are larger contracts. They're typically 6 figures and above annual funding needs. And the client has the capability, if they chose to, that they could create liquidity or cash flow to fund the policy directly. But number three, the reason they use financing is because it's an inefficient use of capital for their situation. So they need insurance, they can afford insurance, but diverting capital from their primary or best use scenario to fund life insurance is not as efficient as them keeping money invested in real estate, reinvesting in their corporation, staying in a highly concentrated position that maybe the market volatility or they expect it to grow, or there's a not very helpful tax consequence to selling out of it. Or they are, for some of the wealthier clients, they've already used up all their gifting. They've already done all the gifting out of their estate up to their estate tax limit, but they still need to do more. So gifting cash isn't efficient. That's what I look for. Need insurance, can afford insurance, efficient dollars is not as efficient as putting them into their own business. So what we do is we structure financing as an efficiency practice. It's to figure out what's the most beneficial use of capital that they have.
That's incredible. I love that. So it's about leverage. Well, it's about those three principles you outlined. Making sure they have identified the need, they have the means to pay for it, and it serves one of those functions. And that's incredible. I mean, I think that's an amazing use of a really creative way to do it. So break that down in terms of like, if somebody's looking to create more tax efficiency, how does premium finance help them?
So it depends which tax efficiency you're talking about.
Okay.
And that's
now. Are we doing is it something that could serve them in terms of tax efficiency in their own income while they're alive, or is it tax efficiency for their estate?
So I've seen them for both. And so answering in order, what I look at is that if it's tax efficiency while they're alive, this would be the fact pattern. Client sat down with their financial team. They've identified they need to build up a certain amount of assets for their retirement or lifestyle income. And they realized that life insurance would be a valuable asset for that. They like the tax deferred growth. They like the tax-free income. They like the fact that there's protection around it. They like that if it's IUL, they like that they have a collared exposure to index growth. If it's whole life, they love the idea of a high dividend paying long-term mutual company. They love the idea of life insurance for it. Number two, they have the ability to do it. They're actively distributing capital into investment buckets. But number three is that they realize that if I invest in the market, or if I invest in these assets, or I invest in these private businesses, I'm going to get X dollars of growth. And they've already done some tax efficient investing. They've probably maxed out any qualified accounts they have or done things like that. So now the determination is my capital best used being deployed into a life insurance policy, or should I deploy my capital into another investment vehicle and finance the insurance and actually build up both assets at the same time? Because then in the future, what happens is we would look at paying off the loan with the growth of those outside assets, or paying off the loan with the cash value of the insurance contract itself, if it's worked out that way.
Okay.
Or if they pass away, God forbid, if they die while this is outstanding, their loan is going to be paid off with a death benefit, and their family gets both the investment portfolio and the remainder of the life insurance. And that's all tax-free as well.
Wow. So
tax efficiency during their life is one structure, or tax efficiency for their heirs, for next generation. The example I always use, and this is kind of a normal client for us, is someone's made their wealth either in real estate, or they've sold a private business and bought into real estate. They have very large real estate portfolios. So imagine a client who has, in 2022, they have about a $50 million real estate portfolio. They have a $26 million tax exemption between mom and dad, or the two partners, if there's two of them, or 13 million if it's an individual. But they have $50 million, $26 million of tax-free passing. So 24 million of that is going to be taxed at the current federal estate tax level. And if they live in a state which also has an estate tax, that'll be exposed as well. So just for simple numbers, the idea is that if the parents have a $50 million portfolio of real estate and they pass away, their children are going to receive $50 million of real estate. The government's going to say you get 26 for free. So 24 is taxed at 40%, which is just under $10 million. They're going to get 50 million of real estate and a $10 million tax bill that's due in 9 months. And the government doesn't take deeds. They don't take property. They don't take shares of an apartment building. They don't take a strip mall or a self-storage unit. They also don't take stocks or bonds. What they take is cash. And so now the family has to figure out, how do we liquidate enough capital to get $10 million out of this portfolio? Because most families that have $50 million of real estate, they don't have $10 million of cash. And so their options are they can sell some properties, which if you look today, probably not the best time to be trying to liquidate $10 million of properties.
Right. And pretty quickly too, 9 months. I mean, you got to move.
Have you ever heard of an estate sale?
Yeah.
You ever think that's the place you go to get a bargain or to like get some stuff? That's the problem is people have to sell it to pay off their estate. But what we would do instead is we would structure a $10 million life insurance policy for that family. We'd put it in a trust outside of their taxable estate. And we do that just so it's very simple. Now, when mom and dad pass away, children receive a $50 million portfolio of real estate. They receive a $10 million tax bill, and they receive a $10 million death benefit, a checkbook from the insurance company. These two wash each other out, and it just keeps the family business in the family. That's the kind of business that's the key component of the tax efficiency of using life insurance and financing specifically. We would finance that $10 million policy, build their life insurance portfolio the same way they built their real estate portfolio.
It makes complete sense. Yeah. Leverage, interest rate arbitrage, keeping, and that pillar number 3 that you said, identify clients of, is it more efficient for their capital to be working in their business or with their investments than in life insurance? That makes total sense that it meets that need and that criteria. That's a really clean cut way to explain it. That makes total sense. So help me understand, when you say high net worth, is it only for people who have $50 million? Like who is like the ideal candidate? Like give me a range of like age and net worth that would like meet this need.
So there's some limitations.
That's possible. I don't know if that's the right way to do it, but
there's limitations. And so a lot of the insurance carriers actually have a requirement of between $5 and $10 million net worth before they'll approve it. They want to know that clients are high net worth, they're capable, they're doing this as educational, they're very educated clients. Mm-hmm. They don't want people buying this for the wrong reasons, because there are some things that are done in the marketing of it, which try to explain this as free or low cost insurance versus buy now, pay later insurance. And so there's some marketing gimmicks that go into a lot of it. So carriers kind of play defensive by saying we want well-established clients who have the ability to determine whether something is real or not. There are carriers who don't have limitations. They'll go down to maybe 2.5 net worth is where it falls in. Banks that fund these, they generally have a limitation for how much a loan on an annual basis they want to fund. And the minimum I have right now is about 200,000. I think I actually have one bank that'll do 100 still, but they don't want to get involved until it's a $200,000 per year funding. And so what that means is that typically we're looking for clients. My youngest client, the youngest insured I worked on was, I think, 12. It was generation 4 of a dynastic family, but the oldest was in their 70s. So the whole gamut there. Typically, if we want to have good collateral support, it's someone who's under mid 60s. So mid 60s is about if they're healthy mid 60s, we could probably do it and still have good collateral support. So I would say under mid 60s is best. Over that age, we want to have clients that have a lot of liquidity or access to marketable securities or something for collateral. Mm-hmm. And then net worth, my average client is somewhere between 20 and 200 million net worth. We definitely have people who fall outside of that on both directions. I'm doing a case right now. On Tuesday, we're presenting to a client that has a current net worth of about 2.5 million, but he's now in his high income earning years. He had just signed a contract for $2 million of income per year for the next 5 years. Mm-hmm. So he's definitely on a different wealth trajectory going forward. This is a perfect structure for him because he's going to be able to fund a policy that he wants 5 years from now, today at his current health class. 5 years from now, whenever he has the net worth and the ability to fully fund it, it's going to be a paid up contract. So that's a neat one. And then as well, skewing on the hundreds or $1 billion families, we have those as well we've worked with.
That's amazing. So 2 more questions for you. How do you help people to spot when they're being proposed something? And we've had conversations about this. There's definitely like marketers and people out there that are trying to just, I don't know that their principles are as clearly defined in terms of like how they're serving people as yours are. And as putting it as nicely as possible. But how do people know they're staying away from something that's just not probably a good deal? Like, how do they spot something that if they're being proposed, they go, that doesn't seem right?
That's it. I think if your gut tells, I think you can, people are smart. People can feel when something seems off. And I think when it comes to life insurance, you trust your gut. There's a lot of marketing schemes that are out there. And you said it up front. My values are transparency and integrity. And so what that means for me is, if someone wants to see how great something could look or how good it can perform on paper, I'm an engineer. I'll dig into the analysis. I'm going to question all of the assumptions, and we're going to build a different model for people so they know the risk that they're heading into. I just recommend sending it over to you and saying, hey, let's schedule time to go through this. What do you think? You and I can run through that together very quickly. And I'll point out, here's some things I think are maybe egregious assumptions. Here's some things that you're not seeing stress testing on. The hard part is everyone who presents this, every single person presents it as conservative. And that's a word that they attach to it. But I don't think it makes sense. There's so many moving parts to life insurance contracts are complex. There's a lot of toggles and switches the insurance carrier gets to use. And there's a lot of assumptions that are used when they put together an analysis. Now, without really digging into that and the financing, your clients I think they're presented a lot of things that are hard to figure out. My recommendation is this: if you're presented a premium financing proposal, you ask for two things to go with the sales sheet you're given. One is that the life insurance carrier illustration that created that proposal, the entirety of it, with cost and charges pages, everything, and an understanding of how the interest rate that's on the sheet is calculated. And with those two things, remember we talked about it's as simple as a life insurance policy and a loan?
Yeah.
I go back in a review and I say, great, I don't want to see the combination. I don't want to see how your marketing has whizzed this thing up.
Yeah.
Let me see the life insurance and let me see the loan, and we'll grade them on both of their merits. Because if a client wants to take risk, we have clients who take risks. We have clients who love that. They thrive on it, and they've been very successful because of it. I just am not okay with a client stepping into an unknown risk or an unknown consequence to the risk they're taking.
Well said.
Those two things. I want them to be educated on where the risk actually is in the contract and the repercussions of failure.
That's incredible. That's awesome. John, I have one more question, but I want to just check real quick. How would people get access to you? How would people reach out if they have premium finance questions, or they want to look at a case, or they have a case they need help with or something? Like, how would people reach out to you? What's the best way?
Sure. There's two ways, right? They can contact you. I think that as you're paying more attention to this and getting more, astute at it, having you be a first look is a great way to do it. Saying, hey, does this make sense? Does this not? Where should we go? Other way is you can jump on my website. I have a very simple site. It's www.pfreview.com, PF for premium finance.
Makes sense.
And there's a place to request, if you're doing a contract, or if you've already buying into this and you want some ideas on rate quotes for the loan side of it, there's a request for loans, as well as a request to have a meeting and go through some stuff.
That's awesome. I'll drop a link to that. Yeah, we'll have a link to that down below in case anybody wants that. So we'll put that down there so you can reach out to John directly. He's incredible, great person.
Thanks.
Last bonus question for you. Can you go into split dollar agreements for me at all?
Sure. What about them?
What are they? When are they used? And that would be a great start. I think split dollar is incredibly fascinating. I want to do a whole video on just split dollar, but like, if you could just break down, you're probably the best person to ask. So that's why I wanted to find out from you, like, when are you seeing split dollar and where is it really valuable?
So there's two different kinds of split dollar, just as a basis. One is there's corporate split dollar and there's intergenerational split dollar, and they're used for different reasons.
Okay.
So when we look at corporate split dollar, it's a way to use the value of a corporation and its balance sheet to fund insurance for a client. So a lot of times where we're looking at that is a key employee of the end of the corporation. The entity itself is going to make a loan to fund their insurance, and in return, they're either going to charge an interest rate or they're going to receive a portion of the death benefit. There's different ways to structure it. There is a concept that we can do, which is financing corporate split dollar. So an entity which has a value that wants to compensate key employees or shareholders who work in the business. We can do a corporate split dollar where we use the balance sheet of the business to create a loan, which then funds life insurance on the life of that employee. And there's some big tax benefits to doing it that way. Intergenerational split dollar is the concept of using a wealthy portion of the family lineage to make a private loan from one generation to the next. And typically what happens is that generation one will make a loan to a trust for the benefit of generation three. And in that trust, there'll be insurance on the life of generation two. So this is definitely a long-term strategy. We have to incorporate attorneys to create agreements because there is generation skipping issues that we need to pay attention to. But the very basics of it are using assets from Gen 1 for the benefit of the lineage by insuring Generation 2. There are some really neat tax strategies you can do for that, especially if your family is a 50 million plus net worth family and mom and dad are uninsurable. If they are no longer able to get insurance because of health reasons or of age, it's no longer economic, we should definitely talk about that, because there are ways that we can use that insurance agreement to create some really neat strategies. But that'll be a much longer conversation.
That's a whole other video. Yeah. And I'm hoping that we can one day circle back and get a video on that. That's incredible. That's amazing. I always think of that kind of more famous Jim Harbaugh case in terms of like, structuring these types of agreements and things. And I think that's a cool where I kind of got turned on to that. So I'm really pleased to
that's the idea of a corporate split dollar, where you have a key employee and part of your rewards packet is that you're going to fund insurance for them.
That's amazing.
So whenever
on the owner of the business, can the owner of the business be the key person, or does it have to be a key employee? Is there like separation and stuff?
If the owner is an employee.
Okay. Wow. That's incredible. Yeah. We could do a whole nother video. John, thank you so much.
Actually, I'm going to throw one more in there because
please, let's do it. Anything you'll give us, we'll take. I appreciate it.
Where the other value of the corporate split dollar on the Harbaugh, because I always forget about that deal. The big benefit to him is that there was an excise tax that was implemented for nonprofits that have employees over $1 million of annual income. So there was an extra tax hit that their employees were having to pay. And so split dollar is a way to compensate them in a non-salaried way. There's some benefits again to tax. That's what it comes down to. There's some benefits from a tax perspective to compensate.
All right, so since we opened the door, just last thing, walk me through the Harbaugh case. I think it's so interesting how the benefits worked out for the university and for Jim as well. Like, where are those tax benefits for both sides? Can you just walk us through the case real quick?
It's a long one. Well, we should do it. We should do a whole thing on it.
Okay. I just want more, man. I love it. It's so great.
If you have a bunch of university presidents, we could definitely go through that.
Okay. I think that's incredible. John, again, seriously, thank you so much for making time, man. It's always a pleasure. I'm really enjoying what we're working on together. Thank you for everything.
Happy to do it, Daniel. Thank you.
All right, man. Take care. All right. If you want to reach out to John, click the link below, subscribe to this video, share it with somebody that could help. And if you have any comments, please leave them down below. I'll do my best. We'll respond to every single one. If we need to bring John in, we'll get him to reply to some questions that you have. Thanks so much for watching. We'll see you in the next one.